One of the questions I've been posed recently is cash interest rates in my bank account are so high now, why do I need to invest? Why don't I just put all my money in the bank account, I'll get a nice return there, and I can leave it, stick my portfolio on autopilot, and go and do something else instead. I think you need to think very carefully about such a strategy. And what I wanted to do in this video is to go through what I think, in my experience, are some of the issues you ought to consider before following such a strategy. Clearly, there will be times when cash is king, as they say, that you really want to have as much as you possibly can sitting in your bank account. But that's not necessarily a good long-term strategy. And like everything, there is a time and a place for cash. And you might find rather suddenly that it's not the right place to have your money. So let's dive right in and have a look at some of the issues that you should be considering before you stuff everything in your bank account. In other words, you may still need to invest. So here is the summary of the 6 things I'd like you to think about, and we can be covering in some more detail in a minute. Firstly, you want to think about your long-term performance. Secondly, cash interest rates won't always stay as strong as they are right now. Thirdly, you've got no upside in cash. Number 4 is that what happens if inflation goes up? Number 5, banks can go bust. And number 6, everyone will probably tell you that you need to have a diversified portfolio in order to maximize your returns. And sticking all your money in the bank account is not a diversified portfolio. So let's look at each one of those in turn in some more detail. But before I do that, I just want to emphasize this video is here to help you. And if you found it helpful, do please click like on our site, do please click subscribe so other people can find these videos and hopefully they'll find them useful as well. Possibly you want more detail to try and understand how best to invest your money. And if you do, you can see our website at the end of this presentation, and you'll see there are further courses available on our website, which I hope you find will be very interesting for you. So let's now look at the first of these 6 issues. So one of the most important things you need to look at is the long-term performance of your portfolio. Every investor, at least in my view, should really be thinking long-term. Yes, there might be certain trades you could put on which may make you some money this week, next month. But saving for a retirement portfolio or saving for your kids' college education is a long-term issue. And I think most of us are much better about managing long-term trends rather than trying to duck and dive in the market. Getting timing is so difficult. Not many people can do that. I would really think very carefully before you try and go down that road. So if you look at the long-term trends, what you'll see is risk assets perform best on a 10, 20, 30-year view. That means you're probably going to be better off investing in the stock market or in property or in other similar risk assets than by leaving your money sitting in the bank. So if that's the long-term picture, what does it look like over the short term? Well, clearly in the short term, there are times when cash will outperform. We've all remember periods when the stock market has fallen 30%, and clearly the person who's got all their money in cash will do a lot better at that time. You have to ask yourself though, how good are you at picking timing so that you know you can take all of your money out of the stock market just before it sells off and you'll put it back in right at the bottom. I don't think many of us should have the confidence we could do that. And therefore, you have to think long term. And I think you have to believe that over the long term, your risk assets are going to be the best performing assets. So, if that's the case, why do you ever want to hold cash? Firstly, you may need liquidity. You may need to sell investments, and clearly, selling investments can only be done at the right time. You only want to sell equity when the market's up. You don't want to be selling equity under pressure when the market's down. So you always need to keep some money in your bank account. Secondly, you may have a strong view that the market is going to go down, whether it's for property or equity. And if that's your strong view and you really believe it, then go ahead and implement it. There will be times, as I said, when that view will be proven right. But bear in mind, that is a very strong view to be holding, and it's not necessarily a view you want to hold over many years. To give you an example, perhaps, if cash rates you can get in your bank deposit are 4%, and the dividend yield on your equity portfolio is 2%, you'll probably be thinking, well, I'm getting 2% more just by investing my money in the bank, and that's great. But the stock market's only got to go up by 2% a year for it to outperform the bank deposits. How many years does the stock market not go up by 2%? So I do encourage you, therefore, take a view, but always keep that view in the context that leaving your money in the bank does not perform so well over the long term. Now, the second thing to bear in mind is that cash interest rates, at least when I'm making this video, are at some quite elevated levels as the central banks have been raising rates to squeeze inflation out of the system. They won't always be at such elevated levels. There is the likelihood over time that they will come down again. Now, whether they go back to the near zero levels that we had over the last few years, I just don't know. I don't think that's very likely. But they will come down. So putting your money into the bank over the long term could be rather less compelling if you are only getting 1% interest rates rather than the current levels at the time of this video of somewhere around 4%. So do bear that in mind. Once investors start to see cash rates come down, they may start to move their money into other investments which are more lucrative. And you may want to join them. Now, the second thing you want to remember about cash is you've got no upside there. You've got the downside either, that clearly if you put $100 in the bank, when you come to take it out, you've still got your $100 there. But that $100 is not going to turn into $105 or $110. All you're going to get is the interest rate, no more than that. So in other words, there's no capital appreciation if you put your money in a bank deposit rate. You need to look at your savings objectives. You need to look at your kids' college fees, your retirement objectives, and try and figure out whether you think those level of interest rates you're getting in your bank deposit rate will be sufficient to meet your objectives. I think there's a good chance that if you've got no upside in cash, you're missing out on a lot. Now again, that doesn't mean that you should never have your money in bank accounts. But what you want to really bear in mind is that keeping it all there means that the most you're ever going to make is that bank deposit rate. And that's most of the time rather less than the average return you get on equities. Now, here's something to watch out for, which caught us all by surprise a couple of years ago and could yet catch us by surprise, and that's inflation. Because the money you put in the bank is not typically protected against inflation. In other words, you're getting the interest rates you're getting, but the capital isn't going to go anywhere. Do you believe long term that if you think inflation is going to go higher, or even remain around 2 or 3%, you're better off not getting some kind of inflation protection. Now, what do I mean by inflation protection? Well, if you buy equities, the companies usually increase their prices that consumers pay somewhere around the rate of inflation. Their costs go up at the rate of inflation, and therefore their dividends tend to go up somewhere around the rate of inflation. So it means that equity, over the long term, isn't a bad inflation hedge. The same is true for property. If you're, say, a residential landlord, you'll probably over time increase your rents to reflect both the higher cost that you face, higher average earnings, and therefore there's some inflationary increases. And that's why you might feel reasonably comfortable that as a holder of property, higher inflation will in part be covered by either higher rents or a higher capital value for your asset. There's no such direct linkage for bank deposits. I mean, there is a rather tenuous linkage, and the tenuous linkage is this, that if the economy starts to overheat, that pushes inflation up, then you might think the central bank is going to raise rates again, and you will get a bit of a higher interest rate there. So there is a bit of a tenuous link. But if inflation comes from some exogenous source, like higher oil prices, for example, or higher commodity prices, raising interest rates isn't really going to get that down easily. So the linkage between the performance of your bank account and inflation is sort of there, but it's not great. So I think one of the things you need to consider is that if you believe inflation is a real risk to your savings goals, you want to make sure that your assets will perform better in times of inflation. And I would consider that equity and property probably will do better. Obviously, if you're especially concerned about that, then there are inflation-linked government bonds issued by many governments, including the US, France, Germany, and the UK. And if inflation is your concern, then you should look into investments like that, which will give you that type of protection. But certainly, cash deposits are very rarely inflation-linked. Here's an important one to watch out for as well. Banks can go bust. We've seen it in recent years. And when banks go bust, what happens to depositors? Well, of course, it varies. It depends which jurisdiction you're in. It depends whether the bank is forced into a merger with another bank. It depends whether the regulator steps in and protects depositors. I don't know. There's all sorts of different outcomes there, but it's certainly not guaranteed. Now, there are some protections in place in most jurisdictions for deposits underneath a certain level. But if you're putting a lot of savings into your bank account and you're going over that level, in other words, you've got several $100,000 in your bank deposits, you may find you're well over the insurance limit provided by the state. And that can be very worrying indeed. So I'd ask you the question, do you feel comfortable that the bank where you've put your money is not going to go bust? If you don't feel totally comfortable about that, you may want to diversify by splitting your bank deposits amongst lots of different banks, or you might decide there are other asset classes you want to consider which are more secure. So to give you an example, let's say you think there is a recession coming, you're very negative on the global economy. Likelihood of banks going bust, of course, is that much higher. Well, maybe it's safer to put your money in government bonds in that environment where the likelihood of the government defaulting on its own bonds, particularly amongst developed governments like the United States, France, Germany, the United Kingdom, this is very, very low. So I think if you're that negative on the global economy, you need to ask yourself, why am I not buying government bonds? So yes, for small amounts, bank deposits are safe because you may have that insured limit. And again, that depends whereabouts you're located. But for larger amounts of money, you really want to work through in your mind what would happen if the bank you're using goes bust. So here's a critical issue. I just said earlier that if you have a large amount of money you want to put in bank deposits, it makes sense to diversify maybe and put it in lots of different banks. You might also think, well, if diversification is such a great idea, should I have all my assets in bank deposits, or should I ensure that I have some in government bonds where I have some protection against a major downturn in the economy? Maybe I should have some in equity or in property where I have some notional long-term protection against inflation going up, and at least my long-term returns should be better. And maybe if I'm that concerned about inflation, I should be looking at specific inflation-linked assets which are available in some of the developed government bond markets. Do you want to put all your eggs in one basket? Because if you're putting everything in the bank deposits, you're essentially taking the view that you don't think inflation is going to go up very much. You don't think the stock markets are going to perform very much. You don't think there'll be a major recession and therefore your bank won't go bust. There's a lot of views which are sort of embedded in that strategy. Do you hold those views that strongly, or would you rather diversify and account for the possibility that whatever views we might hold about the economy, we're none of us right the whole time, and that by having a diversified portfolio, we're kind of reducing the risk. We're allowing for the fact that we aren't always right 100% of the time. So that's why I think diversifying across lots of different asset classes is always a good strategy to use. And that by sticking all your eggs in one basket and putting the whole lot in bank deposits, you're exposing yourself to a number of risks that you may not have thought of. So I hope this video has been useful and it's given you some food for thought. The question I always ask anyone I speak to is, are you a gambler? And if you're not a gambler, you need to think through very, very carefully what the different economic scenarios might be and how you position your portfolio to allow for those different scenarios that might emerge. To invest in one single asset class, whether it's bank deposits or whether it's a single stock or just equity, in my view is just throwing the dice and hoping that your view turns out right. And I think that is a huge risky strategy. So I hope this has given you some food for thought about the reasons why putting everything in bank deposits, despite the very elevated bank rates you can get right now, could be a risky strategy. Certainly in the short term, you may feel comfortable with it, but keep on monitoring economic developments. Keep on watching where you think you might see some better return. So be prepared. If you have put a lot of money in the bank, there may be a time when it's appropriate to invest again, and it's up to you to identify that time. So keep on monitoring the markets, keep on monitoring the economies, and I think you'll find that very, very helpful. Hope you've enjoyed watching this video. I'll be putting some more videos up again very soon, and please do subscribe, please do click like, it helps other people to find our videos. Thank you so much for watching.